Hey everybody, welcome back to Mangosteen, with this episode being Misti, Under the Hood. I see a lot of commentary around Misti. I see a lot of people not really quite understanding what actually sits under the hood of the Misti investment product. So we're going to go through and understand the covered call strategy today. So what is the covered call strategy? Now the covered call strategy is utilized by Misti, and it is comprised of two components. One being the purchase of the underlying MicroStrategy common stock, and two, the write or sell, depending on your choice of words, of a MicroStrategy call option. Those are the two components that make up a covered call strategy. And we're going to go through each of these components together to understand what they mean. The first component of the covered call strategy is quite easy to understand. That is the purchase of the underlying MicroStrategy common stock. Now, if we have a graph here of the MicroStrategy price and of its profit and loss of our position, if we had a purchase price on the zero axis and we purchased it at this point, and then at some later point the MicroStrategy price went up, we would have profit and we would be in the green. Now, if we owned the MicroStrategy stock and it went down in price, our profit would go negative and we would be in loss. And so when we own MicroStrategy common stock, if the price goes up, we're in profit, everyone's happy. And if the price goes down, we're in loss and no one's happy. Yada, yada, yada. Easy to understand, right? That is the first component of the covered call strategy. Now, the second part of the MicroStrategy covered call strategy is slightly more complicated, and that is the write or sell of a MicroStrategy call option. Now, when you write a call option, you are giving somebody else the right to buy your MicroStrategy shares at a fixed or pre-agreed price. And they would exercise this right if the MicroStrategy price at that time is higher than that agreed strike price or that agreed price. And that could be represented with this red line, where if, in example, we had written a call option at the exact same time we purchased the MicroStrategy shares with a strike price at the exact same purchase price, we would collect a call premium. So the person would pay us a premium for that right to purchase our MicroStrategy shares at an agreed price, and that would become profit. So if the MicroStrategy share price went down, we wouldn't really be worried. We would have collected the premium and we would have made a profit and no problems. Now, the problem arises when you write your call option, the MicroStrategy price goes up, and we suddenly whittle away all our premium, and then after that, the MicroStrategy price continues to go up, and we have lost out all that opportunity to be exposed to MicroStrategy price, and we have to sell MicroStrategy shares to this counterparty or this, somebody else at a below the current market. Now, if we don't own any MicroStrategy shares, we would have to go buy them at a higher price from the market and then sell them to this person at that lower price, locking in this red price. But in the covered call strategy, obviously we have the MicroStrategy shares, we own them. And so what we do is we take this green line, which is our MicroStrategy profit and loss, and we take this red line, which is our right of call option P&L, and we combine them, and we get the following graph. We have this blue line, and this blue line represents the combined option premium and ownership of MicroStrategy shares. Now, in this instance, what we do is we lock in a finite amount of upside, which represents the money we made from the option premium, and the fact that because we already own the MicroStrategy shares, we can just give them to this person. So we don't have to lock in any loss if the MicroStrategy share price goes up. We merely just give them the shares we already own. The problem here arises from the 100% downside risk that we remain exposed to. And that is because if MicroStrategy shares go down, we just own the shares and we get our premium, but we just own lower value shares. Now, if we continue to do that, if the share price goes down and then the next month we run our right covered call strategy again, we lock in the downside for that option premium once again, and we never allow ourselves to be exposed to the recovery of the MicroStrategy share price. And so we just continue to go down. So the only possible way in which the MicroStrategy call option strategy can go is that the overall value of the portfolio has to decline over time, because we're only ever exposed to this finite upside. And then if the price goes down, we lock it in by issuing a new covered call strategy and generating our monthly income. And so let's see if we can observe this behavior in the price action of any other covered call strategies that we see. And so here we have QQQ and QQQY, which is the NASDAQ index and the NASDAQ index covered call strategy, QQY. And what we can see is a perfect example of what I've been trying to talk about and communicate to you guys, which is this locking in of all the downside in an exchange for a monthly income. Now, what we do is we see, QQQY, and we look at the dividends, and they're sort of 80% a year, or they're very high, similar to your Misti, and we're like, wow, 80% dividends. Like, I'd love to own that and then generate 80% dividends. But what we have to remember is that the capital is always going down, and you can see that the capital is down 55% over the last 12 months. Why? Because you can see here that every month we issue our strategy, and then we pay it out, and then we issue our strategy, we pay it out, we issue our strategy, we pay it out, and you can see that things are going down. Now, any downside, so we have some downside here, we had some downside here, we had some downside here, all of that gets locked in here, big downside, that gets locked into the capital that the fund has, and here we have big downside, so we will lose that. Here we have another downside that we lock in, here we have another downside that we lock in. And we just continue to lock in all these losses in exchange for that dividend income. Now, the problem is the dividend income is 80%, but that's 80% on the reduced capital value, and so it's perpetually declining. And so what you have to do is you have to factor in the fact that QQQ was appreciating in value, and I think QQQ does pay a very tiny dividend, a typical sort of tech stock 0.5% dividend or something like that. But you get this capital appreciation over time. Now here you're getting this fat dividend, but actually a lot of that dividend represents the capital loss that you're experiencing. So you can see you got 55% capital loss, maybe an 80% dividend, and then you've got to factor in the fact that you've got to pay tax on all this income, with a lot of that income representing actually the principal or the original capital you invested being converted to income, and then you pay tax on that. So the tax man's like, hey mate, I saw you got some income there. Like, thanks mate, we'll take 20, 30, 40%, depending on where you live. And you go, oh yeah, and you haven't locked in or crystallized any capital loss yet to offset that. And so you're like, shit. So it's not a tremendously efficient investment. And so when you factor in the 80%, you factor in the capital loss, and you factor in the tax that you pay, I think it's more like a 16% return, which is like not bad. Like, it's not bad, but it's not mind-blowing, and it's certainly not retirement level dividend income returns, right? You have to rely on the maintenance of the capital value, which just doesn't exist mathematically. So when we have any like stable MicroStrategy market for any extended period of time, you're going to see the capital value of your Misti decline despite you getting great dividends, and you'll be kind of a little bit disappointed because you're locking in a lot of loss, you're generating a bit of income, but you're paying tax on it. It's just really inefficient. And so you have to be very, very careful about your ownership of Misti. You are speculating on certain things in the market occurring, and that don't always occur. And what you really need is a very, very aggressively bullish market in order to maintain the capital value of your Misti, but also generate the income, which is what we've been experiencing recently, but I'm not saying that we're going to experience that forever, right? Anyway, hope that was interesting. If you find my content interesting, you can subscribe to my YouTube. I'm also on X, and I talk a lot of rubbish on the Irresponsibly Long MicroStrategy group. So, tune in. And of course, most importantly, disclaimer, nothing I say on my channel is financial, legal, or tax advice or any other advice of any kind. Just do all your research. Any trade you make, your own responsibility. This is entertainment only, and I really am just a brainless Mangosteen that you are listening to on the internet, so I warn you.